Hello and very good morning to everyone here today, and what a lovely Tuesday morning it is. Thank you for joining November's edition of Blackfinch's 10-minute market forecast. My name is Josh. I'm Blackfinch's product specialist and act as the subject matter expert for our listed portfolio solutions. And I'm joined today by a very familiar face who's pretty much one of Blackfinch's old guards by this point, Alex Sumner, Commercial Investment Director. And some very quick housekeeping. We have a lot to cover today. Myself and Alex will be taking a tag team approach to this webinar, with Alex doing a quick whistle-stop tour of the events of October, and I'll be tackling what we feel could cause market movements over the month of November. Should you have any questions, please use the Q&A box below, and we'll try to answer them if we can. But we'll reach out after today's webinar if we can't get to them in time. So, Alex, over to you.
Brilliant. Thanks very much, Josh, and thank you all for joining us. Hopefully, as Josh has mentioned, you'll enjoy this new format, and you won't have to put up with my voice for the whole time. As Josh has said, moving to the month of October in review, understandably, news headlines have been dominated with the Hamas terrorist attacks and the ensuing conflict with Israel. Now, up until this point, investment markets have largely held the view that the chances of the conflict escalating outside of this region is unlikely. And we've not seen any major price action with regards to investment instruments that are exclusively linked to the conflict as yet. Of course, though, it has added to the general tone of negativity, which collectively has seen equity markets fall across the month of October, with nowhere really to hide on a regional basis. Bonds, though, they've had a comparably less torrid time of it, particularly when looking at other monthly sort of moves in bond markets. This has been helped undoubtedly by the continuing expectations that we are at peak rates in developed economies. And of course, as the month of October progressed, this was further confirmed by actions that were taken by the US Central Bank, the European Central Bank, and of course, the Bank of England. So, as we've kind of touched on before, major central banks unanimously now seem to be in a wait and see mode. We're very much seeing a continuation of the higher for longer narrative that we've commented previously on these calls. And again, as I say, this has absolutely been backed up by actions taken by the banks. Over in the US, we saw the Federal Reserve holding their rates at 5.5% for a second consecutive time. This was in line basically with the majority of expectations in markets. But I think what markets took as a positive is the reassuring emphasis that Jerome Powell, he gave a speech afterwards, and he said that basically before considering any further hikes from this point, they're going to assess the cumulative impact of previous interest rate hikes and rises. Essentially, they're acknowledging the time lags that are associated with how these sort of interest rate hikes can affect the economy, inflation, financial markets, etc. So it's quite reassuring to see them taking a pause and assessing the damage, if you will, on what's been done. More interestingly, though, he did point out that the dot plot that was released in September, which is basically a prediction of where committee members think interest rates are going to be in the future, may not be accurate anymore. That's quite important, considering that dot plot showed that members forecasted one more hike this year. For it now not to be considered accurate anymore, markets naturally took this as a positive, and we did see a bit of a rally. Just to put a bit of cold water on that, though, Powell also confirmed that the committee had not discussed any rate cuts as yet. Challenging thorn in the side of all this is persistently strong US economic growth. GDP rose about 5% in the third quarter, which really beat expectations of just over 4%. They saw the largest quarterly growth since 2021. So, a very, very strong economy is not going to do inflation any favors. So that is a data point that we're keeping a close eye on and want to watch out for. Over in Europe, again, the holding narrative continued. The ECB, they held their rates at 4.5%. Again, this was in line with expectations, and it was a welcome break from 15 consecutive hikes from the bank. So we've sort of started to see them pause now. A key positive data in the Eurozone was inflation. That came in comfortably below expectations, 2.9% versus 3.1%. And considering that throughout the month as well, we saw some pretty weak economic data from key European economies, it does really paint the picture that it's unlikely we'll see further hikes from the central bank in Europe. At home, start of this month, the Bank of England, again, we also held rates, our level at about 5.25%. And this was despite inflation coming in a little bit hotter than expected at 6.9%. But we have seen much softer economic growth here in the UK, which again helped come to the overall conclusion that we should see rates start to hold at this level again before the economic damage can be assessed from these sort of previous hikes we've seen in the UK. I think, Josh, that's all, unless I've missed anything, and I can hand over to you for the outlook.
Yeah, thanks, Alex. And just quickly on the strength of the US, it's funny, as you mentioned, I'm sure most of you know earnings season's in full swing at the moment. Surprise, surprise, US tech companies are showing actually just how strong they are. I was doing some digging on some data a couple of weeks ago, and actually it's just a handful of stocks that are driving returns this year. And for the film fans out there, it's called the Magnificent Seven. So these are kind of Apple, Alphabet, Meta, Amazon, Microsoft, Nvidia, and Tesla. And without those companies, the MSCI All Countries World Index, or the ACWI, which is typically a way to eyeball loose kind of global market returns, would have actually declined this year. Similar effect with the S&P 500, but one of the big drivers of the stocks has been the kind of AI hype, or artificial intelligence hype. And all seven have a link to that kind of story in some degree, whether it's Microsoft investing in ChatGPT, Nvidia creating chips that kind of power AI. So it's certainly one to watch in the coming months. And in terms of Q3 earnings season, we're nearly at the end. There's about 100 companies to go. But yeah, surprise, surprise, it's tech, it's communications that are underpinning the strength of the US economy. So it's certainly going to be one to watch over the coming quarters to see if that strength is still going to come through. But in terms of two big factors to watch out in November, Alex has touched on the unfortunate kind of Israel-Hamas conflict. Just as an immediate risk, if we do see that conflict escalates, and Iran, who are Hamas's major oil sponsor, do get involved directly, we could see that oil prices spike once again, and it causes a bit of a supply-demand imbalance. And if that is the case, it kind of fans the flames of that kind of stubborn inflation figures, and it could get central banks thinking about monetary policy once again. So it's something that we're aware of and that we're watching, but it could create some near-term kind of market volatility in a worst case or bear case scenario. And for point number two, I'm sure you're pretty much getting fed up of us talking about this now, but the second factor is kind of that would influence market returns is still inflation prints and interest rate decisions. And most of the excitement's already gone at the start of the month. Alex has already touched on the kind of November decisions coming through and to hold. And off the back of that, we saw it was largely US and UK small cap stocks enjoying that kind of pause in rates. But eyes are on December for the rate decisions, which is the 13th of December for the Fed, the 14th for the Bank of England and the ECB. And that's really going to give us some insight on the kind of trajectory of rates at this point. Is it still kind of wait and see? But for November, there is one point for us to watch out for. It's the 14th of November, and that concerns US headline inflation. So the year-on-year figures forecast to be 3.8%, which is a slight uptick from the previous month's 3.7%. And the stickiest and the largest kind of portion of US inflation has been shelter. It still is the case. But there is a forecasted downtick in core, which is quite important, from 4.1% to 4%. The markets could react kindly to that print, as it does show some of that stickiness is slowly starting to come down. Or if there's some inflation surprise on the headline figure, that could also come through as well. But that's the only point for us to touch on in November. I think it covers everything today, so just a minute to spare. So hopefully it's given you some nuggets you can take away to your clients. If there are any questions off the back of today's content, please feel free to reach out through your business development manager or your dedicated email address, which is the strategicteam@blackfinch.com. That's strategicteam@blackfinch.com. But from myself and Alex, thanks for your time today and enjoy the rest of your week. Bye for now.
Thanks very much.